Hello friends. In the last few weeks, I have been expressing certain factors that are weighing on the markets and impacting sentiments. Last week, I even went to the extent of saying that there is a probability that there would be selling on rallies. Now, last week, four additional factors, or rather four factors, not entirely additional, cropped up in the markets that will impact sentiments. Let's start with each one of them and take them case by case. Number one, Moody's came out with its view that while India's GDP will continue to rise, its government debt, sovereign debt, will basically settle down at higher levels. What they were saying was that government borrowings are likely to go up. The second factor was forex reserves, which fell below $600 billion from an all-time high of $645 billion. Last week, they fell by approximately $6 billion to $594.90 billion. That basically unnerved the markets to a certain degree. Thirdly, you had the US Federal Reserve Chairman who gave out the guidance of possibility of higher interest rates as long as US inflation remained sticky. And fourthly, and not in the least, was the statement by George Soros-backed investigative organization of journalists, which said they would come out with a report on India. And that was likely to be slightly incisive. So these were four factors that weighed on sentiments. Now, going forward, what is it likely to be? What will impact sentiments? And when will this overhang of negativity or even pessimism be overcome? What factors will tell us that, okay, the markets are shrugging off all their worries and they're proceeding as business as usual? Let's dive right ahead, and on your screen right now is the market roundup window, which tells us that for a change, it was the broader based Nifty-50 which led the decline, whereas the Bank Nifty remained in the positive. The US dollar index, the Dixie, went up 75 basis points, and the USD INR, which is the dollar versus the Indian rupee, fell. That tells you that the Indian rupee actually gained strength against the dollar. Was it the RBI that sold dollars? It could be possible, which is why our forex reserves have gone down a tad. Now, a strong US dollar basically dragged crude oil prices lower, which fell a little over 3.5%, but natural gas went up a little under 4%. Most of it is cost of carry because the August futures are now expiring and giving way to September. And do remember, in the hurricane season starting from July all the way up to October, you have oil and gas prices that typically seasonally tend to rise. Silver outperformed gold due to short covering, and gold itself went up a little bit. The Indian 10-year benchmark bond yields went down by 2 basis points, which means bond yields went up a little, and that had a positive rub-off on banking stocks. That's how one of the reasons why the Bank Nifty went up. The NSE market capitalization gained a little over 1%, which means the broader base market did not see the impact of selling. It was the Nifty weighted stocks that saw most of the selling. MWPL came down by 8 basis points, which is a little early in the day. Normally, it peaks out on Monday or Tuesday of the expiry week, but now you're seeing that fresh additions in open interest is slowing down. In the US markets, the headline Dow Jones Industrial Average fell a little under 0.5%, but the technology-laden NASDAQ and the broad-based S&P 500 gained. So mixed signals from there. Now, for our in-house indicators, we start with the MWPL. What you're seeing on your screen is the MWPL, although is at the high of this 20-week period of the weekly chart, it's showing signs of tapering. So the possibility of 40% being hit seems to be a little remote because Thursday is the expiry of the August series. But risk appetite does remain high, and I told you last week itself, High risk appetite by way of high MWPL results in higher volatility because one side will surrender their positions, and high build-up tells you that big amounts of positions will have to be surrendered, which means big price moves. Now, for the index and stock futures turnover, do remember these are three concurrent series, August, September, and October. The turnover figures seem to have gone up. Not really a surprise because in the prior week, 15th August was a holiday, so it was a 4-day trading week. Whereas last week we had 5 full trading sessions, so the traded turnover seemed to have gone up. Now for the advanced decline ratio, this is a weekly average of all 5 trading sessions of the week. Advanced decline ratio shot up to 1.20, which indicates a certain amount of short covering as well. Now at 1.20, it means for every 100 falling shares, there were 120 rising shares. As long as the advanced decline ratio remains above 1, bulls still have a chance of reviving sentiments somewhat. Let's watch this. The daily version of this chart is updated on my social media accounts every single day, so do keep in touch there. Now I take you to the prompt month, which is the August month, basis of the Nifty and the Bank Nifty. Basis is the premium or discount prevalent on futures as compared to spot. What you are seeing is that basis of both the indices is inverted, which means negative. Both the futures are trading below spot. That means at higher levels, two Marshmallow traders continue to press sales. Now, as long as the basis is negative, it indicates continued selling pressure. So do monitor the basis. I update this chart on a daily basis on my social media accounts. Let's take the impetus. It is our in-house exclusive indicator. You won't find this anywhere in the public domain. What you are seeing is a divergence in the impetus readings. The Nifty impetus went up and the Nifty itself fell, which means the fall in the Nifty was forceful. The Bank Nifty actually rose, but the impetus reading has fallen, which means the gain in the Bank Nifty was rather mild. Could it be short covering? Yes, possibly it could be short covering, which is why the buying was not exactly forceful. Now I come to another exclusive in-house indicator of ours, which you won't find anywhere on the internet, the lift weight thrust drag indicator, the LWTD. What you are witnessing is the Nifty-50 itself lost a little less last week as compared to the prior week, but the LWTD indicator came down. From 0.11 in the prior week, it was 0.02. That tells you that at lower levels, there might be a little less of short covering support coming in. Not really surprising because it's an expiry week. And people are focused more on unwinding and squaring up their open positions rather than creating fresh ones. Friends, our in-house indicators done. I now come to the bond markets where the weekly chart on your screen is telling you that the Indian benchmark, the 10-year benchmark bond yield fell by 0.02 or 2 basis points. And what you are seeing is we are still in no man's land where laddering of sovereign yields is concerned and or buying gilt funds is concerned. What you are likely to see is in the week ahead how the Indian bond market reacts to the US Federal Reserve guidance of the Fed chair being open to the idea of raising interest rates if required. That will impact our own RBI's Monetary Policy Committee meeting in the coming few weeks itself. Let's keep a keen eye on the bond market. Friends, the bond market's done. I now come to the Bank Nifty, which kind of outperformed the markets by rallying 0.87%. The daily chart on your screen tells you that the Bank Nifty rose on 3 out of 5 trading sessions and the price remains below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. Sure enough, it attempted to break out on Thursday, but it failed and it closed below the average again. The head and shoulder pattern that I had marked on the daily chart still remains in place. Here again, there was an attempt by the bulls to push the price above the neckline on Thursday, but the price has slipped right back below it. What we need to see in the coming week is whether the price rallies above the neckline and stays above it and negates the head and shoulder pattern, or falls below it and validates the pattern again. Now, coming to the weekly chart on your screen, what we are seeing is the bullish candle logged last week, which came after 4 consecutive weeks of decline, was an inverted hammer. That tells you that during the week, bulls attempted to push the prices higher but failed, and the price has settled in the lower end of the weekly range. Luckily, the price is still above the 25-week exponential moving average, which tells you that the medium-term outlook for the market still remains positive. What we need is that the price stay above, sustainably above, the weekly high of 44,950, which is the bare minimum I would look out from the bulls to see them come back convincingly. Friends, in the week before last, this index was at number 3 on the most volatile counters list as per statistical beta rankings in-house. It slipped by 1 notch and fell to number 4. So volatility, relatively speaking, has come down. Last week, I advocated a range between 44,950 on the upside and 42,775 on the downside, which held perfectly well. As a matter of fact, so perfect that the high was exactly 44,950 as I had advocated. In the coming week, I anticipate a range between 45,350 on the upside and 43,125 on the downside. Friends, the Bank Nifty done. I now come to the Nifty-50, which underperformed the Bank Nifty because it fell by 0.23%. And as it tells you on the daily chart on your screen, it rallied on the first 3 trading sessions of the week and fell on Thursday and Friday. The price attempted to rally past the month-long moving average on Thursday, but slipped back below it. So it never really managed a close above the moving average. What you are seeing is a bearish triangle forming, and the price itself has closed at the lowest after 3rd of July 2023. So what we are seeing is a near-term outlook remaining slightly under pressure. A fortnight ago, as you can see on the weekly chart, I had advocated a 3 black crows formation called the Sanba Garasu formation as per Japanese candlestick patterns. Now, these were 3 bearish consecutive candles. Now it has become 5 bearish consecutive candles. That tells you that the selling pressure has actually escalated. The final candle of the week has been inverted hammer, which, like the Bank Nifty, shows a failed up move because the price has settled in the lower end of the weekly range. We need a sustained trade above the weekly high to get the bulls back in charge. Now that will be at 19,585 levels. That's the bare minimum I want to see before I say, okay, the bearishness is gone. And the 4 factors that I mentioned, which were impacting the sentiments negatively, have been overcome. The price is above the 25-week exponential moving average, which is a 6-month long holding on cost of an average bull, which means the medium-term outlook is positive, but for now. In the week before last, this index was number 9 on our most volatile counters list. It rose by 3 notches to number 6, which means volatility on the Nifty has, relatively speaking, picked up. So has the challenge level for an average retail trader. Last week, I advocated a range between 19,675 on the upside and 18,950 on the downside, which held perfectly well. In the coming week, I anticipate a range between 19,650 on the upside and 18,900 on the downside. I would suggest we trade light next week because it's an expiry week. Friends, I now come to the last bit of statistical analysis wherein I track the retail risk appetite by way of the turnover contributed by the 4 F&O segments. What you're seeing on the daily chart on your screen is the index futures turnover came down marginally and the stock futures turnover went up marginally. The stock futures turnover is indicated as a red line and the index futures contribution turnover is as a blue line. Now, as far as index options are concerned, it is denoted by a green color line. You see that index options turnover came down and stock options turnover, which is indicated as a violet purple line, actually went up. That basically tells you that risk appetite has gone up a tad. And this is coming in the expiry week, so a lot of it could be short covering by itself. What we need to see is what happens in the week going ahead. Now, friends, for what I would do in the coming week. Do remember, it's an expiry week, so the number one thing I would do is trade light. And I would continue with my 3-week-old formula of trading in public sector undertaking, PSUs, and off the PSUs in PSBs, public sector banks. And I would also continue to bet on theta decay in the options segment in interest rate sensitives and sectors that are connected with oil and gas and use these two fuels as raw materials. Do remember, in the hurricane season in the US between July to October, prices of these two fuels do seasonally tend to go up. Now, being an expiry week, I would basically be largely quieter, and in my trading patterns, I would basically want to square up my trades, preferably on the same day rather than roll them over to the next trading session. Friends, I now come to the most popular segment of this video, wherein I give you 5 stocks that have gained the most amount of impetus on Friday, where you take small exposure, wait for large price moves, and 5 stocks that have lost the most amount of impetus, where you take big exposure, wait for small price moves. This is for scalpers. And do remember, this list is valid only for Monday, Tuesday through Friday. I update it only on our free Telegram channel. So impetus gainers list, where you take small exposure, is led by Tata Communication, followed by Federal Bank, then GMR Infra, IDFC, and IDFC First Bank. Impetus losers for the day on Friday was led by Apollo Tyres, Z, Britannia, Mahanagar Gas Limited, and Granules. Friends, before I wind up this video, a reminder to subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comments segment, do let me know how my videos are helping you become better traders. Also, help me reach out to a wider audience by sharing my videos with your family and friends and smart traders like yourselves. Thank you for your patience and being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Take care. Bye-bye.